Well, good morning and welcome to the Global View. I'm Nadine Blaney. This is going to be a big day on markets and we have you covered. So all throughout the day on AusBiz, we will continue to examine not just the news, but what it means for your investments, where the opportunities may lie. We'll question whether there is any place to hide. Where do you find protection in this market? And of course, while we all know it's impossible to pick the bottom, when perhaps should you start putting money back into the market? So stay with us throughout the day, the week, the month, however long it takes, and we will continue to stay abreast of what's happening in global markets and what that means for Australian investors. So let's recap what happened on Wall Street on Friday. Our local market is expected to fall at least 4% at the open today after a two-day severe sell-off brought the S&P 500 down over 17% from its record high, with the Nasdaq Composite confirming a bear market on Friday. The benchmark S&P 500 marked its biggest weekly drop since March of 2020. That was the start of COVID-19. And the Nasdaq on Friday ended down more than 20% from its December record high. Those are steep falls for one day that you see on your screen right there. S&P 500 companies lost about $5 trillion in market value, the largest amount ever in a two-day stretch. And that included the big banks. The sell-off coincides with the start of U.S. quarterly earnings season, which begins in earnest with the big banks on Friday. Chip stocks tanked. Look at NVIDIA. Look at Intel, down by 11.5%. Big tech stocks were also hit hard by the threat of import taxes on U.S. goods. So Apple, Microsoft, NVIDIA, Meta all lost ground. We saw U.S. card firms falling as China's tariffs deepen spending, slowdown fears. American Express, Visa, and MasterCard also hit. And foreshadowing moves likely here today, we saw U.S. copper miners fall on recession fears. And we saw BHP, Rio, Southern Copper all falling. One major investment bank is forecasting a 60% chance of recession, up 40% prior to China's move. Also, one to watch here today, James Hardie, U.S.-listed shares plunged to a near two-year low on those buyout concerns. One bright spot, I guess we could bring to you, is U.S. footwear and luxury firms reversed course after Trump said that Vietnam is in talks to reduce tariffs, and that included Nike. Well, U.S. Fed Chair Jerome Powell weighed in on the tariffs, saying they are larger than expected and that the economic fallout, including higher inflation and slower growth, likely will be as well. Now, despite U.S. President Donald Trump saying now would be a good time for the Fed to cut rates, Powell did not address the market meltdown directly. Rather, he reiterated that the Fed faces the same uncertainty engulfing investors and company executives. He said while tariffs are highly likely to generate at least a temporary rise in inflation, it is also possible that the effects could be more persistent. Over the weekend, China said, quote, the market has spoken in rejecting U.S. President Donald Trump's tariffs, calling on Washington for equal-footed consultation. State-run media also said the U.S. should stop using tariffs as a weapon to suppress China's economy and trade. The EU is expected to approve a first set of targeted countermeasures on up to $28 billion of U.S. imports in the coming days, joining Canada and China. That would be an escalation of what some fear would become a global trade war, likely to push countries into recession. The 10-year yield went from 4% to 3.86% in back. Markets are pricing a 45% chance the Fed funds rate will be cut by 25 basis points at the next meeting on the 8th of May and 100% by June. The U.S. dollar closed up 0.9% on the day. Early moves in Asia has seen more pressure being put on the Aussie, with the risk-averse currency dipping below 60 U.S. cents for a short time on Friday. Bitcoin dropped along with risk sentiment. Commodities are coming under pressure across the board this morning. So on Friday, global oil prices plunged about 7% to settle at their lowest level in over 3 years. Brent down by 6.5%. And gold futures also slid as investors sold off bullion to cover their losses from wider market meltdown. Worthwhile noting that we're watching gold coming under further pressure this morning, as is iron ore. So let's travel across the ditch, shall we, and find out what we can expect from the upcoming RBNZ meeting as well. So we've got a big week. Greg Smith from Devon Funds joins me now. Greg, RBNZ to the back burner for now. It is all about this market meltdown. What's happening there? First market in Asia to come online.
Absolutely. And good morning, Nadine. So we actually held up relatively well on Friday. So our market was down just 0.7%. It was actually up on Thursday as well. But we've certainly reversed course this morning. I suppose those US futures are pointing lower as well. So NZX 50, which is a relatively defensive market. I mean, we don't have a lot of companies with direct exposure to the US. So the NZX 50 is down 2.8%. That's the biggest fall for some time, certainly that I can remember. And it's pretty widespread. It seems to be a lot of passive sellings. You have companies which in theory shouldn't be that affected are lower. So Auckland Airport's lower. Utilities are lower. Fonterra is only marginally down. That's dairy's been a bright spot here for New Zealand. A2 Milk down almost 5%. Their largest market's China. They've been trying to get into the US. And then there's Fisher and Paykel Healthcare, which is down 4.5%. Now, 60% of the US sales are supplied from Mexico, which is said to be in compliance with the USMCA agreement, so they shouldn't be caught there. And I'd imagine they will see more manufacturing capacity shifted there. In New Zealand, we've got a 10% tariff, so you'd imagine we see more manufacturing there as well. So panic mode. I think that's probably all that can be sort of described here. I think the fact that Trump, he obviously went off and played golf over the weekend, doesn't seem too bothered about the meltdown sort of going on around him, and you're seeing pretty much everything sort of thrown out the baby with the bathwater, if you like, and it's fairly indiscriminate. And I suppose just as we saw during COVID, we're looking for some sort of antidote to what was seen last week. And I guess at the moment you've really got Trump sort of calling the shots. And I think it's only until he says something or there's some sort of pushback. We've seen, you've mentioned China, obviously they've come through for a retaliatory 34% tariff. And there's a few in his inner circle as well now, which now seem to be sort of going a little bit against what's happening. So Elon Musk, Bill Ackman, he's a close sort of follower as well. He sort of said the president needs to take a time out. So I guess that's sort of what we're all waiting for. But it sort of can be really described as sort of panic selling at the moment.
Panic selling. That's the big question, isn't it? So if we see the local market here in Australia down by 4% more today, likely we will in the coming days see some sort of a market bounce. Whether that's a dead cat bounce or not remains to be seen. But how do you put these moves in perspective as a portfolio holder?
Yeah, that's right. So I suppose, look, you've got to basically just sort of look at, put the emotion aside. I think that's what, all the great investors tell you that, Warren Buffett, I mean, the market typically delivers an emotional response. And we've seen this, fortunately, moves such as these aren't regular, but they do occur. We saw it in the dotcom bust, we saw in the GFC, we saw it in the financial crisis, a la sort of Silicon Valley, and they obviously, of course, saw it in the pandemic. And we saw the reaction there. And those that sort of sold out, it completely got out, at the bottom of that sort of COVID drawdown, obviously, we've sort of left kicking themselves a little bit. So I think it is a time for cool heads. There will be some companies that'll be more affected by this than others. I mean, if you look at in Australia, obviously Breville's been sort of dominating the headlines. Ansell came out and they said that they're going to pass on terms of price rises. So I think it's all about sort of stepping back a little bit, keeping a cool head, maintaining some discipline. As you say, whether we get a bounce, we will get one, and time will only tell whether it's a dead cat one. But I think, if you step back and approach this with a sense of reality, I think there will be growing pressure on Trump to at least examine what he did last week. You've already got this bipartisan bill which is taking shape, which is looking to move tariff decisions back to the Congress, from just the president. So that could be something. You've got people in the inner circle. I think there's going to be growing pressure within the Republican base as well. You've got a lot of people that have seen a big drop in their wealth over the last couple of days. So you think of those 401ks, 60% of Americans, adults that is invest in the stock market. They're not going to be pleased by what they're seeing. in the last couple of days. They're going to be on the phone to their local Republican representative, and this is going to feed up to the White House. So I guess the question, Nadine, is how long does it take for this pressure? We've got the midterms later in the year, and we know, look, students of history will know we had the Act obviously back in the 1930s, and the Republicans that brought that in lost that election in a landslide. We don't sort of have to wait that long, but I think there will be a push for change, some sort of common sense almost to be coming in. We're hearing about how the tech and financial leaders are heading to Florida to try and talk some sense. So, to answer your question, I think it's just really a time for discipline. It's still a good time to look at good quality companies, companies that will sort of navigate the turbulence that we're seeing and will come out on the other side. Worth pointing out, the US economy is still in quite a good shape at the moment. You saw that with the payrolls numbers on Friday. So it's not like, the world's largest economy is in recession yet. I mean, it could head that way, and certainly those risks are elevated, but that could change quite easily. As that announcement was made last week, we could just as easily see some sort of U-turn and some sort of return, I suppose, to common sense.
Okay. So that's what we hope will happen, of course. Common sense, always in short supply, but always a very good thing. How would the RBNZ be reading this? Of course, they meet this week. We will be hearing from our own Governor, Michelle Bullock, and at least one of the major banks here, ANZ Bank, saying that we can expect to see a very distinct shift in rhetoric coming from the Reserve Bank governor here. So what are you anticipating there?
Yeah, completely agree. And of course, this is the first meeting that Adrian or the governor won't be present. So there's now an acting head in Mr. Hawkesby. So there is the opportunity there to sort of divert from what was said at the last meeting. So we had two back-to-back 0.5% rate cuts, and they did flag that we were going to get a 25 basis point rate cut at the meeting on Wednesday. But I think, look, the world has changed since February. And in New Zealand's case, where our base rate or OCR is 3.75%. So our central bank, as you know, we've talked about, went a lot harder than the RBA on the way up. Our economy is in far worse shape. We've only just come out of recession. We're crawling out of that. Confidence measures are low. So you can make an argument quite easily that the cash rate should be below neutral, or at neutral, should I say, even before thinking about this trade war. So that's around 3%. So I think there is a case for them to go for at least 0.5%. I wouldn't rule that out, because one thing that the RBNZ is well known for is reacting aggressively either way during times of crises. And I think we're in a crisis. New Zealand, as I mentioned, is not directly affected so much, but there are elements which will have an impact. And I think one of the most pertinent ones as well is that whilst we're likely to see inflationary pressures in the US, we could well see deflationary forces elsewhere on the globe. And as you see products shipped around away from the US, and that could find its way to New Zealand. That could help our inflation situation. But inflation, where we're sitting at the moment, is already at the bottom of the range for the RBNZ. So I think the case is there to be brave and basically to come and say, look, we're in a not a situation of panic, but we're facing another crisis. Inflation's not only under control, but the risk of sort of falling out at the bottom of the range. We need to cut by 0.5%, and the currency markets are sort of suggesting that this morning, actually, with the weakness in the Kiwi dollar.
Yeah. All right. Well, look, we're out of time. We could talk all day. Greg Smith, thanks for joining us. Good luck out there today.
Thanks, Nadine. Bye now.
Okay. All right. So what does that mean for our local market? It is spelling bloodbath so far at the open, with SPY futures pointing to a loss of 4.25%. Or 331 points. I, though, did speak with Kyle Rutta from Capital.com. That interview is up online. And he fears that the falls could be worse considering what's going on in futures markets as well as commodity markets. So stay with us. We'll get you across the open next.